Okay, let's dive into this. Welcome to today's Explainer, where we're taking a really close look at a topic that is absolutely central to anyone thinking about their financial future. We're talking about building a solid blueprint for retirement using dividend ETFs. You know, if you've ever looked at your savings and just wondered how on earth to turn that hard-earned nest egg into a perpetual cash machine, one that lasts for decades, well, you're in exactly the right place. Today, we're going to completely demystify dividend ETFs. We're going to break down what they are, how they work, and how you can actually use them to construct a super reliable long-term income stream for your retirement. So, it all starts with this fundamental dilemma that pretty much every retiree faces. How do you generate income without cannibalizing your hard-earned assets? Think about it for a second. For years, you've been in this accumulation phase, right? Saving money, buying assets. But the moment you retire, the game changes entirely. Suddenly, you need cash to pay for groceries, travel, healthcare. But if you just start selling off your shares month after month, you risk totally depleting your principal, especially if the market takes a dip at literally the worst possible time. So what we're looking for instead is a smart, strategic approach that provides reliable, consistent cash flow, money deposited right into your account while leaving your actual investments intact to hopefully just keep compounding and growing over time. To get us there, here is our blueprint for the explainer. 1. Dividend ETFs explained. 2. Yield versus dividend growth. 3. Comparing top dividend ETFs. 4. Portfolio assembly and taxes. And 5. Mistakes and takeaways. It's a clear, structured look at the mechanics of retirement income with no hype. All right, Section 1, Dividend ETFs explained. Let's start right at the foundation. A dividend ETF, or exchange-traded fund, is essentially the ultimate financial smoothie. Instead of taking on the massive, let's be real, time-consuming risk of trying to pick individual stock winners in a crazy market, you just buy one single fund, and boom, you instantly own fractional pieces of dozens or even hundreds of dividend-paying juggernauts. This is exactly why they are wildly popular among retirees and income-focused investors. It just offers this incredible instant scale, broad diversification, and that immediate cash flow you crave, basically wrapping the strength of the entire market into one highly efficient package. Now, what's really interesting about this slide is it's basically your exact due diligence checklist, because you definitely shouldn't just buy the first fund you see with a high yield. First, you want a reliable dividend history, meaning durable companies that pay out through good times and bad. You also need dividend growth, so your income actually outpaces inflation. You absolutely must check the expense ratio. That's the annual fee the fund charges, and lower is almost always better. You're also looking for solid portfolio diversification and smart sector allocation, just so you aren't overly exposed if one part of the economy, like tech or real estate, takes a massive hit. Finally, look for good fund size, ample liquidity, and a history of long-term total returns. Remember, it's never just about the quick cash payout. It's about the enduring health of the whole investment. Which leads us directly into Section 2, Yield versus Dividend Growth. Okay, there is a fundamental tug-of-war in dividend investing. On one side, you've got high dividend yield. This is your income now. These funds pay a larger percentage of their share price out as cash right away. On the flip side, you have long-term dividend growth, or income later. Now, these funds might pay you a little less today, but the companies inside them have an aggressive history of bumping up their payouts year after year. It's kind of like, think of high yield as the raw horsepower of a muscle car, right? It gets you moving super fast with lots of cash up front. Dividend growth, on the other hand, well, that's your fuel efficiency. It ensures you actually have enough gas in the tank to make it to the end of a very long road trip, ruthlessly protecting your purchasing power against inflation over a 30-year retirement. So, what does this all mean for you? Should you prioritize income, dividend growth, or total return? The absolute truth is, there's no single universal answer. It entirely depends on your specific phase of retirement. If you're retiring literally tomorrow and you desperately need maximum cash flow right now to pay the mortgage, well, you might strategically lean a bit more toward yield. But if you're in your early 60s and planning a retirement that could easily stretch 3 decades, you desperately need dividend growth. Otherwise, your income is going to completely lose its purchasing power 10 years down the line. Let's move to Section 3 and see how this builds into real-world applications by comparing top dividend ETFs. All right, let's look at the actual blueprint of the market's heavyweights. We aren't endorsing or picking any winners here, but rather just objectively mapping out strategies across things like yield, expenses, and strengths. Take funds like VIG or DGRO. Their primary strategy is heavily focused on that long-term fuel efficiency we talked about. Their current yield might look a little low, but their core strength is holding companies that consistently grow their payouts year over year. Then you have funds like VYM or SPYD. Their strategy totally swings toward the raw horsepower. They intentionally target companies paying higher current yields. Great for immediate income, for sure, but a drawback is they probably won't grow that payout quite as fast. Next up is SCHD, which attempts to strike this meticulous balance, looking for quality companies with both a decent yield and a history of growth. And finally, you've got more complex, specialized strategies like JEPI, which actually uses options contracts to generate even higher premium income. The massive takeaway here is that every single one of these ETFs has a completely different ideal investor profile. Your job is to weigh these distinct strategies against your own personal needs.
Okay, shifting gears to Section 4. Picking the right materials is only half the job. Now it's time for portfolio assembly and taxes.
Look, relying on just one single fund is a massive rookie mistake. A practical, resilient retirement portfolio requires you to mix different strategies so you can weather any economic storm. Imagine, for example, allocating 40% to high yield for that necessary current income, another 40% to dividend growth to fiercely fight off future inflation, and then maybe 20% in a premium income fund just as an extra cash flow booster. By mixing it up like this, you create a deeply balanced system. It basically ensures that if one specific sector of the market completely struggles or cuts payouts, your entire retirement stream doesn't just dry up overnight.
But as we assemble this, we literally cannot ignore Uncle Sam. U.S. tax considerations are huge here because not all dividends are taxed equally. A lot of standard equity ETFs pay what are called qualified dividends, which actually benefit from a much lower capital gains tax rate compared to your standard income tax. However, some of those complex premium income funds, they pay ordinary dividends, which get taxed at higher regular brackets. Fun fact, and this is a big one, putting the wrong type of dividend fund in a standard taxable account can cost you thousands in unnecessary taxes every single year. This is exactly why utilizing tax-advantaged accounts like IRAs and Roth IRAs is an absolute superpower for retirees. If you hold those high-yielding ordinary dividend funds inside a Roth IRA, for example, all that income can potentially be generated and withdrawn completely tax-free. So always consider where you are holding these funds, not just what funds you hold.
Let's bring it all home with Section 5, mistakes and key takeaways. So the crucial point is knowing what hazards to avoid. Even with a flawless blueprint, things can go really wrong. The number one mistake? Chasing the absolute highest yield. Guys, a massive double-digit yield is almost always a yield trap. It's like a giant, delicious piece of cheese just sitting on a financial mousetrap. It usually means the underlying stock price is plummeting, and the market is bracing for a massive dividend cut soon. The second major mistake is ignoring expense ratios. Paying a 1% annual fee might sound like nothing today, but compounded over a 20-year retirement, it will literally eat a catastrophic hole in your nest egg. And finally, overlooking diversification. Please don't put all your retirement eggs in one high-yield basket. Before you make any moves, I want you to remember these 3 golden rules from today's explainer. Number 1, balance. Always, always balance your need for immediate yield with the necessity of long-term growth. Don't sacrifice your future purchasing power for a quick cash grab today. Number 2, diversify. Mix up those different ETF strategies to protect the integrity of your overall portfolio. And number 3, align. Make sure your investment choices perfectly match your personal timeline and your risk tolerance. Stick to cold, hard, long-term investing principles supported by historical evidence, not some fleeting short-term market prediction. I'm going to leave you with one final provocative thought. What is the exact right balance of yield and growth for your personal retirement horizon? Because at the end of the day, there is no absolute best dividend ETF in the world. There's only the best ETF for you, your specific income requirements, and your unique lifestyle goals. Take a hard, strategic look at your timeline, review the exact mechanics we've mapped out today, and start building your blueprint. Thanks so much for joining me on this explainer, and keep learning.